Good morning, good afternoon, good evening, traders from around the world. My name is Trader Allen. My website, wall street2easystreet.com. That's Wall Street, the number 2, easystreet.com. I'd like to take a minute to discuss with you all about market volatility, something that's really either misunderstood or not even understood at all by most retail traders, and why when they get stopped out all the time they tend to blame it on the market maker or the broker or somebody's out to screw them, when really the reason why they get stopped out is because they don't understand volatility of the markets. So let's take a look here. This is the euro dollar. This is the last 3 days. Today is Sunday, March 2nd. Sunday, March 2nd. So this would have been Wednesday, Thursday, and Friday of last week. And what we have here from this high down to this low, it was 7 hours and the market moved 96 pips. Then it turned from this point, went up to this point here. So 9 hours later, we're up 36 pips. Then from this point back down to our swing low, we had 52 pips in 8 hours. Then from this point up to our next high, 7 bars later, we had 85 pips. Then from this point back down to here, 13 hours later, we're back down 36 pips. Then again from this point here on Friday all the way to our high, it's 13 hours, we moved 130 pips. So regardless where you went long here, and since we've been up trending all month long of February, we'd only be looking to go long in the markets. So where in the world would we buy and not get stopped out if we were placing our stops at, say, 10 pips, 20 pips, 30 pips away, even 40 or 50 pips away? We still would have got stopped out numerous times, and we're still right on the direction of the market. We knew the market was heading up. That's why we were looking to go long. And regardless of where you were entering, unless you took into account volatility, you were stopped out and probably coming up with some excuse about why, when really it's just a matter of not understanding market volatility. So let's take a look at a daily chart, the euro dollar. So here we are, daily chart, and what we've done here is we've applied a channel to our daily chart, just a random channel thrown on the chart. It's a linear regression channel, and real quickly we can see that our channel is 114 pips. So at any given time the market tends to move 114 pips. So for us to trade efficiently, we need to have our stop outside of that 114 pip mark, or we're going to get stopped out repeatedly just by normal volatility of the markets. So let's take a look at how we could use this to our advantage. Let's assume, since the market's been going up for, like I said, most of the month here, February, that we entered on the low of this candle here, and we just randomly entered the market to buy long. Had we done that, our stop being 114 pips away, even at the low of the last several days, which was 53 pips from our entry, we would still be in the market. So the market swung down 53 pips. We're still in the market because our stop was 114 pips away. And we currently, at this very moment, would be setting 59 pips in profit. Now, that's, to me, is a good position to be in. And then let's take into account, let's say we entered on the high of this day here. We entered there on the high. During the day, we traded down as much as 93 pips. Our stop being, of course, 114 pips of our volatility. So basically we'd be outside of that, so maybe 115, 120 pips. even throughout the entire volatile day of 93 pips, we're still long in the market. And we currently would be setting 74 pips in profit at this very moment. So even though we've entered the market, we've traded down 93 pips, we're now setting at 74 pips profit. That to me is a much better way to trade. And if you learn how to use this volatility efficiently into your advantage, you must use proper money management. You don't want to risk more than 1% of your account at any given time on anything. So you would end up buying a smaller position size, but you would be making more pips and more profits in the long run because you'd be getting stopped out less often. Using a method like this, you should increase your win percentage or win-loss rate dramatically just by understanding proper money management and how to set your stops outside of it. I hope you enjoyed this video, and please feel free to visit my website, Wall Street, the number 2 easystreet.com, and good trading to everybody.